Berkshire Hathaway has been selling shares for 14 quarters in a row. 2 months ago, they made a strange purchase. They spent $6.8 billion to buy US home builder Tyler Morrison. They're not buying American housing because it's doing well. They're buying because they expect it to get cheap. And remember, every trade has two sides. If Berkshire is the buyer, somebody desperate is the seller. So if you own a home or you've got a deposit sitting in cash right now, the next 12 months decide which side of that trade you end up on. Today, US mortgage rates are above 6%, which means 88 million American households cannot afford a new home. Meanwhile, real wages for private sector workers dropped 0.4%. Home buyers are disappearing. So today, I want to walk you through 4 things. First, why do home builders always break first? Then, the credit market refusing to give investors their money back. Then we get to where has the smart money gone and how all of this lines up almost perfectly in the 18-year cycle. So let's get straight into it. Most people think a housing crash starts with prices falling. I think they're wrong. Prices are the last thing to move because sellers refuse to drop their asking price for months before they finally accept the market has changed. We see it across the globe. The thing that moves first is the builder's margin. A homeowner can refuse to sell and stay put, but a builder can't. Builders have land on the books, a construction loan ticking over, and a finished house sitting there and costing them money every day it doesn't sell. So the builder is their forced seller in the market. That's why the builder survey is the earliest honest number about the housing market. The index is just a monthly survey asking builders how business feels. Above 50 means most of them are optimistic. Between 40 and 50 means most are worried, and below 40 means the industry thinks it's in trouble. Currently, it's at 34, which tells us that the home builders think the market is in trouble. Why would they think such a thing? Well, all you need to do is look at months of supply. This means how long it would take to clear the unsold stock at the current sales pace. Around 6 months is normal. Above 10 months means the market is struggling. Today, we're at 10.3 months. Builders' behavior tells us a similar story. 63% of builders are using incentives to sell houses. The most common incentive is a mortgage rate buy-down. Instead of cutting the price of the house, the builder pays the bank a lump of cash to lower your interest rate. So your monthly repayment drops and the house gets cheaper for you to live in. But the price tag never changes, which is obviously misleading for a market. Let me put that into household terms. A $400,000 loan at 6%, you're paying roughly $2,400 per month. Buy that rate down to 5% and you're closer to $2,150. So that free incentive is worth about $250 per month to you, and every dollar of it comes straight out of the builder's profit. This works to begin with, but only while margins can absorb it. They can't absorb it forever. So the obvious question is, who's supposed to step in and buy all of this stock? For 20 years, the answer was the same. The Federal Reserve cuts its interest rates, mortgage rates fall, the buyers come back into the market, and the builders can clear their inventory. But this mechanism isn't possible this time around. Kevin Walsh is the new Fed chairman. He has held rates at 3.5 to 3.75 through June and July because US inflation was still running around 3.5% in June, with food and energy prices up from the Iran conflict. That's a story for another day. What you need to know is when inflation is high, the Fed won't cut rates to rescue home builders, so housing demand won't miraculously come back. Plus, the household on the other side of this transaction is not getting stronger either. Consumer sentiment hit a record low of 44.8 in May of this year. It has come back to 55 by July, which looks like a recovery, but it's still running 11 to 12% below where it was a year ago. And the survey showed something else. The wealth gap between people who own shares and people who don't is opening up again. Economists call it a K-shaped economy. You probably heard about that before. If you own assets, your wealth is growing faster than your bills. So if you just live off a wage, your life is getting more expensive. Most consumers don't own assets, which is why they're struggling to pay their bills. There's another crack emerging, and this one's bigger than the builders. Private credit is lending done by investment funds instead of banks. When a company needs a loan, the bank says no, and one of these funds writes the check. This market was $500 billion back in 2014. Today, it's somewhere between $2 and $3 trillion. For years, it was sold to ordinary investors with a promise. You could take your money out every quarter up to a limit, usually 5% of the fund. In the first 3 months of this year, investors asked for more than $20 billion back from the biggest funds. The managers paid out roughly half. In the second quarter, requests exceeded the limits at 8 major funds. One Blue Owl fund had investors asking for 38% of all the money in it. So the fund started gating, which means refusing to hand investors their own money back. BlackRock, Blackstone, Apollo, Blue Owl, and KKR have all gated funds this year. Now, here's why this is affecting housing. Since 2008, most of America's new lending has happened through these funds. They finance the land, the construction loans, and the small builders behind housing estates. When these funds have to keep cash aside for investors demanding their money back, they stop writing new loans. So the money that builds houses is drying up, and the loans are going bad. A record 6% are in trouble according to Fitch. In 60% of those cases, the borrowers have stopped paying interest on their loans. A loan is only worth what you'll get paid back. If the borrower is healthy, a $1 million loan is worth $1 million. If the borrower is struggling, you might only see half of it, so the loan is worth half. Every quarter, these funds tell investors what their loans are worth. Officially, they still say full price, but some of these funds trade on the stock market where real buyers set the price. It's the smart money, so they call it. And those buyers will only pay 75 cents for every dollar the fund claims. So the market believes a quarter of the money is never coming back. The funds just won't say it yet. Apollo has started admitting it, valuing one loan at 40 cents on the dollar. And somebody's retirement savings are inside that loan. Now, none of this is a national headline yet, and that's exactly my point. Downturns never hit everywhere at once. They move sector to sector in the same order roughly every time. First to be affected are the business carrying the biggest loans. That's our builders and developers who borrow before they earn. Second, the businesses that only survive when borrowing stays cheap. Last, the house you live in protected by a fixed rate. That's why everything still feels normal from your front door. Homeowners feel the pain last, and the pain, I think, is coming. However, there are ways to avoid this pain. As we talk about so often, we don't want to get involved and stuck in the pain. That would be the worst thing to do when we can see tides turning. You can often see what is next based on what governments are doing. Central banks bought a record 289 tons of gold in 3 months, while the price was crashing and ordinary investors were panic selling. Governments buy gold when they're worried about the monetary system. It doesn't mean it's always the smartest thing to do, but that's typically what we see them do. A record quarter tells me they're very worried. Now, let's take a look at the stock market. The 10 biggest companies make up 43% of the S&P 500, the highest ratio since 1964. So if your pension sits in an index fund, you're not spread across 500 companies. You're mostly betting on 10 or so. And Stan Druckenmiller, a billionaire with one of the best track records in history, has spotted it. He's told us about it for quite some time. He's been selling the giants, Meta, Tesla, Nvidia, and buying a version of the S&P where all 500 companies get an equal slice. The billionaire is stepping away from the bet your pension funds are making. So the governments are preparing, and the best investors are preparing. The only people not preparing are ordinary savers. Now, before we get into every solution, you need to know what to expect next. Everything we've spoken about clicks into place when you see the pattern running underneath it. Real estate moves in rhythms of roughly 18 years. That's about 14 years up, 4 years down. Fred Harrison seen it in the UK, and Phil Anderson has looked at it in the land sale data in the US for over 200 years. This framework allowed Fred to call the 2008 crash years before it happened, and not every year leading into it, just for that year. The last major US housing bottom was around 2011 to 2012, and so we count 14 years up from that point, and we land right around now. The final stretch of that boom, we know it has a name. It's called the winner's curse. It's a phase where the last buyers pay the highest prices with the thinnest deposits at the worst possible moment in the cycle. We see it across the globe, even in Australia, really, really heavily here. Credit is leaving the system through funds that can't honor redemptions. The Fed is holding rates at 3.75 with inflation at 3.5 and no appetite to rescue anybody just yet. And the builders, who are the only participants in property who can't wait it out, are giving away their margin one buy down at a time. Every peak in history came with a story explaining why it couldn't turn. In 1929, it was a new era of permanent prosperity. In 2007, it was the Great Moderation. And in 2026, it's the AI productivity miracle and an engineered soft landing. We're already seeing what's happening before every major housing crash plays out. Right, so let me be fair here, because I'm not here to sell you doom. We want to have a solution to these problems, not just look at all the bad side. I'm not always right, and I've obviously been wrong many times. So let's look at the other side of this equation too. US growth in the first quarter came in at 2.1% annualized, which is not a recession. 58% of the strongest economists don't expect a recession within 12 months, while consumer sentiment has bounced off its record low. And you can even defend the stock market bubble argument right now. The top 10 companies in the S&P generate about 30% of its total earnings, which is different to the previous stock market crashes. These are real cash flows to back up the upside, which is why JP Morgan's private bank predicts the S&P 500 at 8,200 by middle of next year. So we could be a little early here. This can grind sideways for longer than the bears can stay patient, but I'd rather be prepared slightly early than completely caught out, especially when the asset in question is the one that you and I live in. When you weigh it all up, the negatives outnumber the positives. So let's have a recap. Signal one is the builders. Sentiment at 34, 15 months under 50, 10 months of unsold stock. And nearly 2/3 of them pay cash out of their own margin to keep the headline house price intact. This shows early cracks in the housing market. Signal two is the credit. Redemption requests at 38% of the net asset value of one fund, gates across 6 of the biggest names in the industry. And a real loan market at 40 cents on the dollar. The foundation of the housing market seems to be drying up. Signal three is the positioning. Look at the central banks buying 289 tons of gold while the price is dropping, or Druckenmiller hiding in equal weighted stocks, or Berkshire's nearly $400 billion cash pile. All three of the forces point to the exact same direction, which brings me back to where we started. The most cash-heavy patient buyers in America spent $6.8 billion on home builders this year. They're buying the balance sheet of an industry they expect to get cheaper first. So here's what to do with all of this. If you own your own home and the repayments are comfortable, you don't need to do anything dramatic. You're in the strongest position out of anyone watching. But don't build your plan around a rescue rate cut, because the Fed is not coming to the rescue this time. Run one number this week. How many more years do you need to stay put for your current loan to still be the right decision? If you bought in the last 2 or so years near the top, or you took a builder buy down that resets in the coming years, this is the moment to act. Open your loan documents and find the date your rate steps up. Then stress test your budget at a 7.5% mortgage rate. If that figure scares you, start putting the difference aside now, every month until you've got 6 months of repayments in cash. That buffer will stop you from being a forced seller. You don't want to be a forced seller at these stages of the cycle. Now, just got to be patient from that. You're watching a market where more than 1/3 of builders are cutting base prices and nearly 2/3 are handing out incentives, but it's easy to get complacent here. Do not catch a falling knife on the first decent headline. What you should be doing right now is walking through display homes, asking the sales rep one specific question. How much of this price is the buy down? Get them to tell you what the house costs without the incentives are, because that number is the real price. Now, here are 3 all of us should watch from here. Watch the Builders Index. A print back above 40 tells me the industry may have found a floor, and anything below 34 tells me they've given up on the next year. Watch new home months of supply. Under 8, my thesis is wrong. Above 11, and the discounting gets disorderly. And watch the next round of private credit redemption requests against that 5% cap, because if more funds gate, credit is leaving the system faster than any central bank is admitting. Then apply a test to your own postcode. Count the listings carrying price cuts on your street. These things will tell us whether we're right, early, or wrong. Now, I want you to think about this next part. Does inflation cool enough that the Fed can start cutting into 2027? Will mortgage rates drift lower? Do builders get a break, or does the credit side crack first and the discounting spread out of new homes into everything else? Give your answers in the comments. I'll be reading every single one of them and replying to as many as possible. I'll see you guys in the next video. Until then, take care and peace out.